The word mortgage is a French word. Mort meaning dead and gage meaning pledge. The dead pledge. What are the parts of a mortgage? P-I-T-I. So there are actually lots of different types of loans that you can get. It's how I started in real estate. It can save you tens of thousands of dollars. All right, so what really is a mortgage? A mortgage is a promise. You want to buy a house, and so you promise that you will make your mortgage payments or you will give the house back to the bank. What's interesting is actually the word mortgage is a French word. Mort meaning dead and gage meaning pledge, the dead pledge. The reason it means that is because a mortgage doesn't ever go away unless, of course, you pay it off, or when you die, the mortgage does not stay in place. Now, what are the parts of a mortgage? I was referring to P-I-T-I. It's an acronym for all the different parts. So let's start with P, the principal. So if you buy a house for $380,000, a typical mortgage is going to require you to put 20% down. So your remaining balance, right, is 80%. That is the principal. It's your loan balance. You're going to have a certain part of a payment that goes to pay this down every month. And it will slowly just drop until eventually that will be paid off and you won't have a mortgage anymore. Now, the principal combined with the second part, interest, are the largest pieces of your mortgage payment. The interest is the amount that the bank gets paid for even giving you a mortgage to begin with. They're not going to do it for free. They want to make money. The principal pays down, your interest goes in their pocket. Very important that you need to know is the way that this is structured. Typically, a mortgage is amortized, basically meaning over 30 years, that principal and interest is calculated on a monthly basis. So after 30 years, you make your last payment and it's gone, paid off. But what does the bank do? Do they make it a 50-50 split? No, of course they don't. They front load almost all the interest. So 95%, super high percentage or so of your payment goes to pay off their interest first. So the bank makes all their money. And so your principal is a lot smaller portion of that. And so it just doesn't go down very quickly. So if you only own a home for a short amount of time, the principal, the amount you owe, might be almost the same amount that you bought it at. Your interest portion is heavily affected by what interest rate you get, also what type of loan you get, which we will be going into in a minute. Now, P-I-T-I. So we got the T and the I left. The T stands for taxes. Now this is your property taxes. This is not sales tax. This isn't a tax you get because you bought a house like we pay when we buy other things. This is property taxes. This is the government. Because you own property, you have to pay taxes. This is something that even if your mortgage gets paid off, you will forever owe property taxes. The government also supersedes any and all debts. So you have a mortgage, which is a debt that if something were to happen to you or you stop making a payment, the bank can come and try to take your house away. If you also don't pay your taxes, the government can do the same thing, but they get paid first. The bank wants to make sure that the government gets their money. They include the portion of taxes that they need to collect on a monthly basis as part of your mortgage payment. They collect this and they put it into a bank account called an escrow account. And it sits there and it accumulates until taxes are due and they make that payment for you. The benefit to you is the convenience. You don't have to stay on top of your property taxes because they will always be paid for you and the bank will make sure. The last letter is the I, P-I-T-I. This stands for insurance. This also is money that goes into that same escrow account that gets collected and paid out for you on your behalf to whatever insurance company you chose to go with at the beginning. Because how does the bank stand to lose money at this point if you didn't have insurance? Well, if a fire were to happen and the house goes up in flames, what house are they able to take back if you stop making payments? And are you going to make payments on something when there's nothing left there? They're going to guarantee that that doesn't happen by making you pay a portion of your insurance every month as well. So in quick summary, your mortgage payment consists of your principal, your interest, taxes, and insurance. P-I-T-I. So there are actually lots of different types of loans that you can get when you're trying to buy your house. Some of them have restrictions and we'll go over those. But a few things that apply to almost all of these loans are going to be, are you going to get a fixed rate or a variable rate? And are you going to have a balloon payment? A fixed rate is when you have an interest throughout the whole term of the loan, 30 years, it never changes. That's going to give you predictability and the best terms typically. Variable rate means you might start off with a lower rate than the fixed, but it also might end up higher at different times. It actually will adjust with the market. You must pay super close attention to the actual written terms of this because you need to know how high it might get and can you afford that payment. Sometimes these can even be what's called ARMs. It's a 5-1 ARM, meaning you'll get a fixed rate for 5 years and then every 1 year after that, it will be a variable rate and it will adjust. These ARM loans are becoming quite popular right now as the market's going down. Just like a fixed rate and a variable rate apply to most of these type of loans, there is another part of a loan that can be changed, and that has to do with the length of the loan. Loans can be for 10 years, 20 years, 30 years. Now, most of them are for 30 years, but we can also change if we want to abruptly end the loan. That is called a balloon payment because it's like the principal, the amount that's owed, it's popped and everything is due. An example of this would be to amortize a loan over 30 years, so you have this smaller monthly payment, but at the 10-year mark, all the rest of the money is due. You either need to pay that in full or you need to go and refinance before that and put a new loan in place. These can apply to almost every single type of loan. There's actually 5 types, so let's get through it. The first type that most of you are aware of is called a conventional loan. This is where the bank started. They came out with you needed 20% down and they will give you great terms. However, these loans must conform to their rules. So they say, oh, we don't want any loans over this amount, meaning you can't buy a super expensive house. And they have all these guidelines to where if the house fits in this box, they're gonna give you the best rates, the best terms, because they then go and sell it off to investors, and that's how they can give predictability to the investors they sell to. That is a conventional loan. The second type of loan is if it doesn't conform to this box, like you're super rich and want to buy a really nice house in New York, San Francisco, you're gonna have to get what's called a jumbo loan. It's still a loan, but you're gonna have higher interest. You're not gonna have to conform to the rules, and they might not go a full 30 years. The third, fourth, and fifth type of loan are government-backed loans. Now, the government, through studies, realized that home ownership played a huge part on whether someone was wealthy or not. Owning real estate gave you wealth. They thought, how can we help more people buy homes? So they came up with 3 products in order to help that. The first product was the USDA. This was in more rural areas, classified for USDA. So most large cities don't qualify, and the house, the property has to qualify, and then the individual, also there is a few little fees that you have to pay to do this type of loan over other types. However, this loan, the huge benefit is it can be 0 down with some people. Huge benefit, look into it, especially if you live in a rural area. The second type of government loan is the VA loan. They saw a major problem with their veterans, right? They're off fighting a war and then they come back and they don't have any savings. So how are they supposed to buy a house? The VA loan allows them to buy a house with 0 down. They get competitive interest, and so it's a great loan program for them. The government does give these veterans a certain max amount that they're allowed to use, so they can use all of this when they buy 1 home, or they can buy 2 houses. As long as the total is at or less than their allowable amount, they can get a 0 down loan. This is a massive benefit, and veterans should be using this all the time. Now, this leads us to the third government-backed loan type, or 5th loan type overall. This is one I love and I'm super excited about. It's how I started in real estate. It can save you tens of thousands of dollars, is the FHA loan. I'm not a veteran, I wasn't able to put down 0, but an FHA loan, which comes from the Federal Housing Administration, allows you to put down as little as 3.5%. The average home in the US is worth $380,000. So instead of putting down almost $80,000, you can put down 15. So you either can save that money or you never have to save it to begin with, and you can actually buy a home earlier. This helps a lot of people buy a home when they never would have been able to, or not until they're quite older. You get a competitive interest rate. However, you do have to add in what's called PMI, private mortgage insurance. What this does is for any loan where the down payment is less than 20%, the PMI must be applied, and it's actually private mortgage insurance for the bank. It's something that you have to pay to protect the bank. The reason down payments are typically 20% is because if you don't pay your mortgage, the bank gets the house back. Do they want the house back with no equity when they're about to incur some costs to sell that house and they'll come out negative? Of course not. They take a down payment to give them security, and that's why it's typically 20%. With less than 20%, you pay for insurance, so that way if you stop making your mortgage payment, the bank takes your house back and they cash out the policy, giving them money to cover those expenses. So that way the bank doesn't lose. Those are the 5 different types of loans. I know this might have sounded a lot like I was just rattling out the ABCs with the PITI and PMI, but these are very important terms, and now you can be the smartest person in the room when it comes to mortgages. Don't forget to like and subscribe. At least hit the little bell because we put out new videos every Thursday. So click the next one.